Well, everyone's been expecting the Fed to do a pivot, and the Fed just said, you can pivot on my dick because I ain't ready to turn that money printer back on just yet. I've been pretty confused recently because I can't even figure out what people think a pivot is anyway. Is a pivot actually the Fed lowering interest rates, pausing, or just slowing down the rate of interest rate hikes that they've been doing up until this point? I think that a pivot is actually whenever they start to lower interest rates, and then you've got a pause and a slowdown. I think a slowdown is coming, but it is very early to be talking about a pivot probably. I have mentioned a pivot in the past, definitely, and I probably was expecting it to come a little bit sooner than what the Fed is alluding to now. But like the Fed is saying, they were expecting inflation to start coming down now, but they haven't seen it happen up until this point, so they have to continue being restrictive, and that might take a little bit of time. Let's see what they had to say.
Today, the FOMC raised our policy interest rate by 75 basis points, and we continue to anticipate that ongoing increases will be appropriate. Restoring price stability will likely require maintaining a restrictive stance of policy for some time. Inflation remains well above our longer-run goal of 2%, and the recent inflation data again have come in higher than expected. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation.
So it sounds like they are going to have to continue doing rate hikes, but they're not saying that they're going to have to continue doing increasingly higher rate hikes, meaning that there's probably not a 100 basis point hike and possibly not even more 75 basis point hikes coming in the future. This means that they are still going to have to raise interest rates, meaning that there's going to probably be a series of 50 basis point hikes and then 25 basis point hikes before they do inevitably pause in the future. This means that it could be throughout the whole first quarter of next year that we continue seeing them raise interest rates until we start to see inflation coming down reasonably, and then they can start talking about that pause.
That's why we say in our statement that in determining the pace of future increases in the target range, we will take into account the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation. At some point, as I've said in the last two press conferences, it will become appropriate to slow the pace of increases as we approach the level of interest rates that will be sufficiently restrictive to bring inflation down to our 2% goal.
So in other words, they do believe that inflation is going to start coming down, but that the data does work on a lag, so they are going to possibly be able to slow down those interest rate hikes while they do wait on the inflation data to actually come in, showing that they have started to see some progress coming from what they've done up until now. Throughout this whole press conference, he keeps reiterating that it's going to take time and that they have to keep really on the gas pedal to keep inflation under pressure to start coming down. And they can't really let off of that because if it does come back, then we're going to have a situation just like the 70s, and then we're going to be having stagflation, which is something that we all want to avoid.
There is significant uncertainty around that level of interest rates. Even so, we still have some ways to go. And incoming data since our last meeting suggests that the ultimate level of interest rates will be higher than previously expected.
Unfortunately, inflation data hasn't been coming down like they've been wanting to see, so they continue to have to increase their projected interest rate hikes for the future or where they expect to actually have interest rates at before they can pause. This is unfortunate, and hopefully we will start to see inflation data come down so that they don't have to continue raising their target rate to a higher level, and then we might be able to start seeing that light at the end of the tunnel or the pause coming in the future.
The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. So I think you can think about our tightening program as really addressing three questions. The first of which was, and has been, how fast to go. The second is how high to raise our policy rate. And the third will be eventually how long to remain at a restrictive level. So I would say as we come closer to that level, move more into restrictive territory, the question of speed becomes less important than the second and third questions. And that's why I've said at the last two press conferences that at some point it will become appropriate to slow the pace of increases.
So this means, like I keep saying, like he keeps reiterating, that they believe they are going to be coming to a point soon that they can start to slow the rate of interest rate hikes, meaning that they can move to 50 basis point hikes instead of 75. That doesn't mean that they're going to pause, and it's definitely going to be a while until they can actually start lowering those interest rates.
So that time is coming, and it may come as soon as the next meeting or the one after that.
Luckily, though, it does look like possibly even as soon as the next meeting in December, we could start to see them putting out 50 basis point hikes instead of 75. And with the market being a forward-looking indicator, everybody's going to be thinking that that means that a pause is coming soon in the future, and the markets can probably start to recover.
I'm pleased that we have moved as fast as we have. I don't think we've over-tightened. I think there's very difficult to make a case that our current level is too tight, given that inflation still runs well above the federal funds rate. Remember, though, that we still think there's a need for ongoing rate increases, and we have some ground left to cover here, and cover it we will.
He keeps saying that, and that means there's not a pivot coming right now. It's probably going to be at least through the first quarter that they're going to continue raising interest rates, even though it will probably be a lower level. They are going to continue raising rates, and then eventually, if inflation data does start to come down, then they will be able to pause, hopefully, in the next few months or so.
So this is the question of does the policy rate need to get above the inflation rate? And I would say there are a range of views on that. That's the classic Taylor principle view. But I would think you'd look more at a forward-looking measure of inflation to look at that. But
so essentially, a lot of people are saying that they have to get the interest rate hikes above the level of inflation to get inflation under control. And he's debating this right here, saying that he actually prefers to look at the expectations for forward-looking indicators of where inflation is going to be, meaning basically the 5-year break-even. And the 5-year break-even is about 2%, meaning that inflation expectations are headed to the downside in the future, but there's still some ground to cover on interest rate hikes before it actually starts to look like inflation is heading down to 2%.
Remembering, of course, that if we were to over-tighten, we could then use our tools strongly to support the economy. Whereas if we don't get inflation under control because we don't tighten enough, now we're in a situation where inflation will become entrenched, and the costs, the employment costs in particular, will be much higher potentially. So from a risk management standpoint, we want to be sure that we don't make the mistake of either failing to tighten enough or loosening policy too soon.
Essentially, he just said that they're going to continue doing what they're doing because he doesn't care if they crush the economy. They can always make that money printer go brr again, and then they can bring us out of the depression or whatever the hell they put us into. I was going to play a lot more of this video, but basically he just keeps saying the same thing over and over again. Whenever people ask him questions, he just says that they still have a lot of ground to cover and that inflation really isn't starting to come down as far as they can see right now. They're going to continue looking at the data, and if inflation is continuing to be really strong and they can't get it under control, then they are going to continue raising rates at an aggressive pace. And if it does start to come down, then they are looking forward to seeing that they could be having a pause coming up soon. And then after that, if inflation continues to come down, then inevitably, eventually they will be lowering interest rates again. But if they see inflation coming back up, then they're going to have to be more aggressive. In my opinion, this doesn't really change anything as far as the market goes. I still think that we've probably reached the bottom unless we see some really bad news come out. And I think that it is probably going to go sideways for a while and bore a few people left in the market out of the market. But it's going to represent the best opportunity to accumulate and make life-changing wealth in the future, because as the market is at the floor, you really are going to want to dollar cost average and try to accumulate as much as you can. Let me know in the comments, do you guys think that there is possibly a pivot coming, or do you think that the Fed has a lot more work to do? Either way, thank you guys so much for watching. I hope you have a wonderful day, and I'll see you next time. Bye.